Have you ever wondered why retail real estate is becoming a hot topic among investors? Well, here's a statistic that'll get your attention. Private equity investments in Indian real estate have reached a whopping 2.4 billion United States dollars in the first half of 2025. Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. According to a report by Savills India, private equity investments in Indian real estate surged by 38% year-on-year in the first half of 2025. Retail real estate has emerged as a key focus, highlighted by Blackstone's $378 million United States dollars investment in Kolkata's South City Mall, marking the largest retail deal of the quarter. The second quarter alone saw inflows of 1.6 billion United States dollars, nearly double that of the previous quarter, driven by increasing investor appetite for diversified asset classes. Commercial office spaces led the charge with a 31% share in the second quarter, while retail, hospitality, and student housing collectively indicated a broader shift towards consumption-driven segments. The spike in private equity activity, especially in the retail space, underscores growing investor confidence in India's consumption-led real estate growth. Land deals also gained significant traction, accounting for 40% of private equity inflows in the first half of 2025, a notable increase from 13% in 2024. Mumbai dominated this trend, attracting nearly 70% of land investments, driven by infrastructure-led development and urban expansion. Foreign investors remained a dominant force, contributing 76% of the total private equity inflows, reinforcing global interest in Indian real estate. Other significant deals included investments from Sumitomo and Brookfield, who together invested 446 million United States dollars in assets linked to the Mumbai Metropolitan Region Development Authority. These developments highlight the vibrant and dynamic nature of the Indian real estate market as it continues to attract global interest. The Dallas Business Journal reports that Scott Everett, Chief Executive Officer and founder of S2 Capital, has successfully closed a second funding round, raising 373 million United States dollars. This significant funding underscores the confidence investors have in S2 Capital's ability to identify and execute multifamily investments in high-growth markets. S2 Capital has established a reputation for its strategic focus on multifamily properties, which has proven to be a lucrative segment in the commercial real estate market. The latest funding round is a testament to the strong investor interest in multifamily properties, particularly in regions experiencing rapid growth and urbanization. This development is indicative of a broader trend in the real estate sector, where multifamily investments are increasingly attracting substantial capital. The appeal lies in the steady demand for housing solutions in urban centers, driven by population growth and shifting demographic preferences. S2 Capital's success in securing this funding also highlights the importance of having a seasoned and experienced team capable of navigating the complexities of the real estate market. Their ability to execute large-scale investments efficiently has positioned them as a leader in the multifamily segment. This trend of increased investment in multifamily properties is not just limited to the United States. In Canada, regions such as Kitchener-Waterloo, London, and Cambridge, Ontario, are also witnessing a surge in multifamily developments. These areas are becoming attractive to investors due to their strong economic fundamentals and growing population. Cross-border interest is evident as well, with American investors looking towards Canadian markets for opportunities in multifamily real estate. This cross-border relevance underscores the interconnected nature of the real estate markets and the shared opportunities that exist between the United States and Canada. According to a recent report by Mexico Business, Mexico's industrial real estate sector is entering an adjustment phase following a historic boom driven by nearshoring. Availability rates are on the rise and demand has slowed, but the market remains fundamentally strong. This strength is supported by structural shifts in global supply chains and continued interest from foreign investors. The report highlights that the initial surge in demand for industrial space in key Mexican markets like Monterrey, Guadalajara, and Mexico City has tempered. This adjustment is attributed to external factors, such as United States trade policies, cautious investment behavior, and economic uncertainty. Data from INEGI's monthly indicator of industrial activity show minimal growth in industrial activity, with only a 0.1% increase in April 2025 compared to the previous month, and a 0.7% annual decline. The construction sector is also experiencing a contraction, down 2.7% year over year. Nationally, vacancy rates have risen from 1% to an average of 6%, fueled by projects initiated in 2024 and a slowdown in leasing. The national inventory has surpassed 105 million square meters, posing challenges for developers and investors who are navigating a more complex environment. In Mexico City, over 2 million square meters of industrial space is under development, with 55% allocated to built-to-suit projects. Despite the challenges, net absorption in the first quarter of 2025 reached 176,515.7 square meters, reflecting tight supply and growing demand, particularly for last-mile logistics and Class A facilities. Monterrey has seen a 10.9% increase in industrial inventory year over year, reaching 16.4 million square meters. Although vacancy has risen to 5.7%, much of the new supply was pre-leased, indicating market confidence. However, net absorption has turned negative amid slowed leasing of speculative builds. Guadalajara and the Bajío region continue to attract investment, with significant construction underway in El Salto and other submarkets. Despite a slowdown, these areas are poised for a leasing uptick, particularly in submarkets like Aeropuerto and El Marqués. Saltillo has surpassed 5 million square meters in industrial inventory, with a strong pipeline of built-to-suit and speculative projects under construction. Vacancy rates are expected to stabilize around 1.7%, according to CBRE. Despite the current adjustment phase, the structural trend toward nearshoring remains a driving force for Mexico's industrial real estate sector. The relocation of supply chains continues to be a long-term advantage for the country, supported by its labor quality and strategic location. Innovation and adaptability are becoming key differentiators in the industrial real estate market. Clients are increasingly seeking productivity through modular storage, automation, and smarter layouts, which increase density and reduce the need for physical expansion. Energy distribution remains a concern, with some developers exploring distributed solar generation and auto supply schemes to address grid bottlenecks. Technology and innovation are crucial for overcoming current challenges and enhancing the resilience of infrastructure networks. A commercial-to-residential project has been proposed in Orient Heights, East Boston. Joseph Recupero, a developer known for several projects in the area, has submitted a plan to repurpose and expand a commercial property located at 1214 to 1222 Bennington Street. The proposal includes converting the site into a 28-unit apartment complex while retaining the existing structures. The new development would feature a 4-story, 30,602 square foot apartment building, complete with ground floor commercial space. The estimated cost of the project is approximately 8.2 million United States dollars, with 7.2 million United States dollars allocated for construction. Notably, the project plans to maintain the current 18 parking spaces available on the site. The property, owned by Recupero since 1990, is situated near the Massachusetts Bay Transportation Authority's Suffolk Downs Station. The project aligns with the zoning district regulations of the Saratoga Street Economic Development Area, as outlined in the application submitted to the Boston Planning Department. Community benefits from the project include on-site income-restricted units and contributions to the Boston Transportation Department's Bike Share program. Additional community benefits are expected to be determined during the small project review process, according to a cover letter by Richard Linz, an attorney from East Boston. The leading index for commercial real estate increased by an impressive 7% in June, according to a recent report by Calculated Risk. This growth is reflected in the Dodge Momentum Index, which is issued by Dodge Construction Network. The index rose by 6.8% in June, reaching 225.1, up from the downwardly revised May reading of 210.9. Sarah Martin, Associate Director of Forecasting at Dodge Construction Network, stated that non-residential planning showed steady improvement in June. Notably, there was strength in warehouse, recreational, and data center planning. However, planning momentum in other key sectors, such as education, hotels, and retail stores, was more subdued due to expectations for weaker consumer spending and travel demand, alongside volatility around funding. The report highlighted that warehouse activity gained substantive momentum in June, and data center planning levels remained robust. On the institutional side, large recreational projects contributed to the month-over-month gain, while healthcare planning momentum continued to accelerate. When compared to year-ago levels, the Dodge Momentum Index was up by 20% in June. The commercial segment experienced an 11% increase from June 2024, and the institutional segment saw a 46% rise after a weak June last year. If all data center projects between 2023 and 2025 are excluded, commercial planning would still be up 12% from year-ago levels, and the entire index would be up by 23%. The Dodge Momentum Index is a monthly measure of the value of non-residential building projects going into planning, and it's shown to lead construction spending for non-residential buildings by a full year. This index suggests a pickup in mid-2025, although there is some uncertainty that might impact these projects. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.